Welcome to SilverOak's quarterly webinar. This webinar is scheduled to last approximately 45 minutes, and as usual, a copy of it will be posted to the SilverOak website within the next few days. If you have any questions throughout today's webinar, please feel free to contact your SilverOak advisor. If you're not currently working with a SilverOak advisor, feel free to contact me directly at 952-896-5701. And I guess I should introduce myself. I am Shannon King, President, Partner, and Chief Compliance Officer of SilverOak, and with me is Jonathan Charlo, also one of our partners and our lead analyst. I want to thank Jonathan and the rest of our team who worked very diligently to put together the materials for these webinars. It really does take a village to pull all this together in a relatively timely fashion. For compliance purposes, I must note that we will be discussing the overall markets and the economy during this webinar. In doing so, we will be providing our interpretations and perspectives, but you should also note that this information cannot be relied upon as fact when making any investment decisions. And we are not providing guarantees of future performance or success. I think the saying goes, past performance is no guarantee of future success, right, Jonathan?
Yeah, I've heard that before.
We'll also be discussing today SilverOak overall strategies, but we're not going to be discussing specific portfolio performance as each of our clients' portfolios are customized. Every client should have received already their quarterly performance reports within the last couple of weeks, and most clients probably have had an opportunity to speak with their advisor regarding those reports. If you haven't had a chance to speak with your advisor and you have questions, we certainly encourage you to reach out to your SilverOak advisor. Again, we're trying to do a good job proactively of reaching out to all of our clients ahead of time. So with that, Jonathan, let's look at today's agenda. So as typical, we're going to start with a discussion around economic data. We'll transition then into a discussion on the markets. And these two sections, starting our last webinar, we've tried to condense a bit so that we could shorten the webinar to the 45-minute segment and also bring in some other discussion points. So we'll talk about SilverOak's outlook after going through the market data, but we're going to, after that, look at the portfolio strategy and market volatility, slides that we put together. This is something new, something that clients have requested. So I encourage you after today's webinar to suggest topics that you might want to hear. Reach out to your SilverOak advisor and provide those topics. The portfolio strategy and market volatility section was in direct response to some feedback that we received from clients saying that this is something they'd like to see. And of course, we'll also go through SilverOak's updates and other important reminders. So with that, Jonathan, let's start with the economy. You say here slowing growth during the third quarter.
The economy is still doing relatively well. The consumer is strong. That's important. It makes up 70% of the economy. But even that side is slowing a little bit. And not surprisingly, we've seen a little bit more weakness on the corporate side, and we'll see that in slides today.
So starting big picture, we'll look at the market dashboard. And as usual, the market dashboard is made up of four major components. The economic data, which you'll see here in the second quarter is shaded gray, and the projection for third quarter remains a gray shade. So just to remind everybody how this works. In each column is a quarter. So we're looking back all the way through third quarter of 2016. We're projecting out what the future might look like. If the box for the quarter is green, that is a positive indicator. If it's gray, it's neutral. And if it's red, it's a negative indicator. So here the economic data is basically neutral. If we go to the next basket, it's credit markets. That currently, I guess, is green, positive, but we have it projecting going to a more neutral stand during this third quarter, correct?
That's correct.
And then we have valuations. They had been negative or high for a period of time, all the way through 2016 into 17 and early 18. That shifted to a more neutral stance in the fourth quarter of 2018, which I'm sure everybody remembers. It was a very, very difficult quarter in the stock markets, and we're going to see some of that data in a few minutes. And really, since that fourth quarter, it's remained in that neutral category and is expected to stay there for some period of time. And the last of the four buckets for the market dashboard is market sentiment. And that had turned negative earlier this year, but rebounded quite considerably and is now in more of the positive territory and projected, frankly, for the next quarter or so to stay in that positive. Now, I should note that these projections really past a quarter, certainly past 2 quarters. These are projections. I mean, a lot can change over a very short period of time, but this is what the trajectory looks like for each of these 4 baskets. So that brings us to our composite, which had been very positive for a period of time, but has turned more neutral and remains neutral at this point. If we want to see the details, or at least a little bit more of the details of what's making up the dashboard, we can look here at the actual numbers, or at least the composite numbers. And the key here is that red line that goes across. That's a 3.25 dashboard composite number. You can see that to the far right. Anything above that line tends to indicate positive sentiment moving forward in the markets. Anything below tends to indicate more negative sentiment moving forward in the markets. I'm going to highlight here, this is the S&P 500. So that's the blue line is the S&P 500 going back all the way to 1990. So obviously, we've had a good run up in stocks really since the Great Recession. The next item I'm going to highlight, though, is the current composite, which is literally right at kind of that break-even point between positive and negative sentiments. We're in kind of this, I wouldn't call it no man's land, but certainly kind of this area where slight positive underlying data could shift this up, but slightly negative underlying data could shift it down. Anything that you want to add to that, Jonathan?
No, again, as you mentioned, our projections are essentially taking current data trends and really just pushing that out a little bit. And so if we were to see any changes in those trends, that would show up in this composite score.
And as we move down into, or if we were to move down into the more negative, that would make us a bit more defensive, because we have seen a correlation as these composite numbers start falling, that there will be a pullback at some point. Presumably, it's not a guarantee, but history has shown that there's a pullback then in the overall markets. And that's really what we are looking at this for. Now, I should probably add one other thing, not to belabor the issue, but nobody can time the markets. So it's not as if we see this go negative and we sell all of our stocks. It's just how we look at managing cash flow and cash, and are we maybe a little bit more skewed on equities or a little bit more skewed on bonds, but we're not using this as a market timing tool. Here we're going to shift into the economic factors scorecard. And if you look back at prior webinars, you're going to see the scorecard, and you'll see how things have shifted from one quarter to the next. We have not made any changes in any of the underlying components or factors between the various positive, neutral, and negative categories, correct?
That's correct.
We've only maybe shifted sentiment within those categories. So for example, tell us about credit markets.
So the credit markets are generally still fairly positive. The Fed is lowering interest rates, a lot of positive factors there. However, we did see some strains during the last quarter. You may or may not have heard, but there were days in the repo markets where basically yields really rose.
So the repo markets are the overnight lending markets. So overnight banks are lending with the Federal Reserve, and the Federal Reserve target rate is 2%. So overnight, you would think, as banks are borrowing from the Federal Reserve and such, they're borrowing at 2%. But the repo markets shot those rates from 2 up to like 10%. Is that?
That's correct.
Okay.
And in fact, the Fed then had to step in for a period to help add liquidity to those markets.
To lower the 10% back down to 2 where it's really supposed to be.
Exactly. Now, things like it seems like things have kind of settled down again. That was an isolated incident, but we did want to note that that's really, we haven't seen that in a number of years.
Right. And there is some talk that liquidity could be the next, I don't know about black swan, but the next concern. And maybe we might see some concerns with the repo markets again later in the year, but something to monitor. Not a lot of people have heard about it. Again, nothing changed within categories, so these factors within the neutral have remained the same as last quarter, but a few sentiment changes. So
put a positive arrow in housing. We had talked about how housing was a bit more weak to neutral in the recent past. With lower interest rates, though, we have seen some pickup in housing numbers. Now, it's hard to know whether that's a 1 or 2 month trend, and then we'll kind of settle back to where we were. But more recently, some of the housing numbers have actually improved a little bit.
And some of that improvement is because of
interest rates. Now,
right.
We have a positive arrow, and that's because interest rates have generally come down. We've seen mortgage rates come down, and again, that probably has helped the housing activity. Now, we have a negative arrow on China. Now, China has been a situation that we've really been watching for a few years. We've seen their growth rates come down. They have added a lot of liquidity into their markets in the last quarter or so. But the other side is that with the trade war, with the tariffs, that is definitely having an impact. And what we've seen from China in the last quarter is the kind of improvement that people were starting to see and hoping to see. That looks like it's stalled. Mm-hmm. And so that's why we have a negative arrow.
And then within the negative factors, we have a positive arrow on tariffs, which seems a little bit odd, but
it's just a nuance shift.
Okay.
Because we basically had an agreement. We could say maybe it was a truce, or we both kind of walked away from putting in the October tariffs.
Right.
Now, there are still December tariffs. The president has said that those still could be instituted. There are still even thoughts that they're still negotiating the last agreement in terms
Sure.
of the details. So just a slight positive arrow, again, still in the negative column.
And the Eurozone, unfortunately,
it just continues to slip.
Yeah.
We talk about this a little bit later, but Europe is teetering on the edge of a recession.
I think their latest GDP came in at 0.2, which was lower than the 0.5 prior. So it's not headed in the right direction, and it's close to going negative. So let's talk about LEI. And LEI, by the way, stands for Leading Economic Indicators.
Right, and this is an indicator that's watched. It is kind of one of the main leading economic indicators, hence the title. And what you're going to see is certainly for the last year, we're still at a high level, but you're going to see that that's been flattening. If you look back to 15, 16, we also saw a flattening. And you'd mentioned that everyone is trying to figure out if there's going to be a recession, when there's going to be a recession. People are watching this. We're watching it also because of the flatness we saw in 15 and 16, and then it accelerated. And so everyone's watching this to see whether it's rolling over from here or whether it might reaccelerate.
Right. But of course, in 18, kind of the acceleration, we also had tax cuts. So we had some fiscal policy that maybe helped propel some of that growth too.
Absolutely. And then we're also 2 more years into this expansion.
Right.
So we're in the 11th year, longest on record. So it's getting long in the tooth, so to speak.
Earnings. So earnings are still positive, but you're saying growth has moderated.
Yes. So last year we saw double-digit earnings growth in several of the quarters, hence because of the corporate tax cuts. Now they would have still been nicely positive without that effect, but we did see that slow down this year. Now in the first and second quarter, originally they were projected to be negative. They did come in with a growth rate of 2 to 3%. And then for the third quarter, they are also being projected to be down. Now we're still early in earnings season. It looks like it's going to be slightly positive to maybe up a little bit, so kind of that same trend. But the real issue is that next year, the first 2 quarters are really looking for 5 to 6% growth and then double-digit growth in the second half of the year. And so when you think of that and you think of where LEI is, there's a little bit of a concern that maybe those numbers are too high. And the other thing,
the expected
growth
for too high
for next year. And this is now the part of the year where we start to see expectations come down. So we'll want to watch that.
Good point. Now we've talked about this slide, I think a couple of times over the webinars in the past year. This is showing the inversion of the yield curve, which is basically when short interest rates are higher than long-term interest rates. Something also followed, much like the LEI, in that every recession in modern history has followed an inversion. However, there's been a couple of inversions that have not then been followed by a recession, so a couple of false alarms. I think here, though, you were wanting to point out the timing of the inversion versus the recession.
Right. So one of the things that's been talked about is that typically following an inversion within 5 to 20 months, you do see a recession. But one of the things that hasn't been talked about is that this inversion actually uninverts first, and then there's a recession. And so we have actually in the last week or so saw the 3-month versus the 10-year Treasury, that actually became uninverted. But the other side to this too, though, is that this has been relatively shallow inversion in the sense that the 2-year versus 10-year has never inverted. So we're not even necessarily sure whether this is a signal or not. Right. Hence, there's no circle.
Right. So you're saying the 2-year versus the 10-year has not officially inverted. It's the 3-month and the 10-year that officially inverted.
That's correct.
Yep.
And now in the last week, it's actually uninverted.
Right. Okay.
So we talked a bit about just the corporate side of the economy is not as strong as the consumer side. And when we look at manufacturing, that's clearly on a global basis been the weakest sector of the global economy. Here we're looking at the PMI, the Purchasing Managers Index. That had been relatively high through early 2018 and had been shifting down through the last year. In the last quarter or so, it has actually shifted below 50, and it's registering a little bit below 48. And that's important because it's basically saying that the manufacturing industry is in slight contraction. And we're seeing that in Europe, especially within Germany. Now, there is another indicator that people watch. It's called the non-manufacturing PMI, kind of known as the services PMI. That's really tracking kind of the consumer side of the economy. That also has been coming down. Now, it stands around 52, so still slightly positive. But that's a number that when that goes below 52, we have definitely seen that happen ahead of other recessions. Again, it hasn't happened, but that's something that people are watching.
So in summary, as we close out the discussion on the economy, we have, looking back to the dashboard, basically a lot of neutrals. Our overall composite's neutral. No doubt, though, looking at this chart with the PMI, looking back at LEI, and looking at some of those other factors like the inversion of the yield curve, no question things are not as rosy as they had been. Maybe not quite to that recessionary level, but the trajectory has certainly weakened. Is that a fair summary?
That's a fair summary.
So let's take that and talk about the markets. Since we just discussed the economy, let's discuss what's really happened in the markets over the last quarter or even year. So we'll start with the equity markets. And for the last quarter, it was kind of a mixed bag. US large cap and mid cap posted positive returns, while most everything else was slightly negative. That doesn't really tell us the whole story for the year, though. On a year-to-date basis, everything's positive when it comes to the equity markets. And you can see here, obviously, US large and mid cap outperforming all other sectors that we're showing. That also, though, doesn't really tell us the story of the whole 12-month rolling period. Because if we add in the fourth quarter of 2018, which gives us a full 12-month rolling period, you're going to see that some of these numbers go back to the negative position like we saw in the third quarter of 2019. And that's because, remember I mentioned earlier, the fourth quarter of 2018 was a terrible quarter in the equity markets. So it's making these one-year rolling numbers in many cases turn negative, while the year-to-date numbers are still very, very positive. Presuming we have a decent quarter in the fourth quarter of this year, we'll see that one-year trailing number turn positive again, because we'll chop off the fourth quarter of last year. And again, most people probably remember that that was a tough quarter to stomach. But had you stomached it, which, knock on wood, all our clients did, they were rewarded by the performance so far this year. If we look here, we have the same periods, but for the bond markets and some other asset class. So here we'll see the bond markets in the third quarter positive. Bonds were, global bonds, excuse me, were slightly down. US bonds positive. Commodities slightly down. Long short basically break even, and real estate in the positive. Year to date, pretty much across the board, as we saw earlier, all the numbers are much higher than in the quarter. But once we add in fourth quarter of last year, many of these numbers don't look quite as good. Now, bonds in the US still look quite good. And frankly, international bonds still look quite good. And that's because as the markets got killed in the fourth quarter, those bonds acted as ballast, that foundation. They did what we expected them to do.
Absolutely. Absolutely.
Okay. So that's a big picture summary of what we've seen for the last quarter, year to date, and on a one-year trailing basis. Now, if we look here at the style of each of these categories, you'll see that small cap during the third quarter obviously underperformed mid and large, and it was pretty much underperformance across both value and growth. Whereas on a year-to-date basis, you're going to see growth still outperformed value. Now, don't get me wrong, value did good.
Mm-hmm.
Growth just did a lot better. Back to the bond markets, and we say here, Jonathan, the bond markets have equity-like returns.
It's been a while, but this year has been an amazing year for bonds. And so again, kind of more average returns when you look at it on the third quarter basis, but it's really when we look at the year to date, you're going to see corporate bonds are up almost 13%, treasury bonds are up more than 10%, the Barclays Ag, kind of the bond index, that's over 8%. And then when we look at the trailing 1 year period, that's when we look at treasury bonds, that's kind of the equity-like returns.
15%.
15%. Corporate bonds, again, 12%. And then when we look at it on a 1 year basis, the Barclays aggregate up more than 10%.
Yeah, that is equity-like returns. Now, I suspect people will look at this and think, wow, great returns. What's in the future? Do we expect these returns to come down a lot? And we're going to touch on that when we look at SilverOak's outlook. So the outlook first from a U.S. economy perspective. We're more than likely late cycle, correct?
Yes, and the question is, how long does the late cycle last? That's the $64,000 question.
But a recession does not appear imminent.
Right.
Data is weakening, no question. We saw that with the economic discussion earlier, but we don't see a recession imminent yet. At some point, it's going to happen. Doesn't have to happen next year. Doesn't even have to happen the following year. It could. We just don't see it yet.
The U.S.-China trade situation, that uncertainty has definitely affected things this year. The question is, does that drag things down even more next year? The Fed, is definitely providing liquidity again, but there's been some challenges, and we talked about the overnight market. Right. Now, the U.S. is doing better than the international economy. We did kind of change our thought here, and what we're saying is that the global policy support, so the European Bank, they're all doing things to hold things up, but it doesn't appear enough to reaccelerate global growth. And that will be the question. If that continues to stall and go down, what will the effect on the U.S. economy be? And we talked about the growth in China stalling, the fact that Europe is teetering on the edge of a recession. The whole Brexit issue is still a wild card that even today is still out there.
Well, I heard Draghi just speak earlier today. I didn't get to hear the entire press conference that he gave, but it sounds like they're actually going to push more stimulant into the economy, into Europe. So, what you said is absolutely right. What they've done so far doesn't seem to have helped, but it sounds like they may be accelerating what they're doing. So we'll see if that has any impact. When it comes to bonds, so this goes back to that comment I made a few minutes ago. Bonds did really, really well so far this year, and really looking back over the last 12 months. Do we think that's going to continue?
Well, the bond yields themselves will probably stay within the current range. Now, if growth stalls significantly, we might see bond yields come down further. So what that means is that after such a high return we've seen over the last year, returns are likely going to be more average.
Sure.
But as you mentioned, they still do offer that protection. And so they were that ballast in the fourth quarter of last year, and they're really in the portfolio to help against that potential.
So we're going to continue to focus on credit quality. If we look back at the chart on bond performance, you can see some of the bonds that had less quality actually have done maybe a little bit better. Treasury is one exception, but in some of those categories with high yield.
The high yield, and that's one area that everyone's watching. It's been somewhat a surprise that with global growth slowing, that the yields are so narrow.
Sure.
And so that's certainly a credit area that we wouldn't want to take a lot of risk in.
Yeah, high yield sounds great until you call it what it really is, and that is
Junk bonds.
exactly. Exactly. As far as equities, S&P valuations are just a little bit above the 25-year average, but we have them on our dashboard as neutral because they're not completely out of line.
Correct. And when we talked about valuation in our model, it was kind of neutral. So that does make sense. Now, again, this has been a great year in terms of performance. So some sort of modest pullback from here is a possibility. And we've talked about what those issues are. And so one of the other things, and we've talked about this before, is it's going to be an election year next year.
Right. Well, and just to be clear, nobody can predict or identify when the next 5% or 10% pullback is. I mean, it's hard to predict when the bigger pullbacks occur, let alone these small 10%, 12% pullbacks, because those happen relatively regularly. All right. We also mentioned here, though, that we do expect wide dispersion of potential outcomes, and that diversification and consistency of investment strategy is more important than ever, which really leads us into our next segment, the portfolio strategy and market volatility discussion. Again, this is something that was requested from past webinars, so I encourage, if you have ideas or topics that you want us to discuss, let your advisor know, and we certainly do what we can to make sure that we address those in future webinars. So I'm going to start this discussion with this very, very busy slide, and I'm going to hopefully make it somewhat simple, but I know there's a lot of stuff going on here. The y-axis are annual returns. The x-axis shows different portfolio makeups. On the far left, we have 0% stocks in the portfolio and 100% bonds. On the far right, we have 100% stocks and 0% bonds. That's where I'm going to start today's discussion on volatility. Let's look at the all-stock portfolio. Over the 1950 to 2018 timeframe, that portfolio would provide an annual average return of about 11%. 68% of the time, that average return would be between 25% positive and negative 18%. So you could expect one standard deviation, which is 68% of the time, returns would be between that 25 positive and 18 negative. Two standard deviations, or 95% of the time, your returns are between a positive 40 and a negative 18. And if you go out three standard deviations, which is literally like 99.2% of the time, you can expect returns between 55 and negative 31. Okay, so that's the way this chart's laid out. That's a 100% stock portfolio. Average return 11% with a wide dispersion of returns based on 68% probability, 95% probability, and 99%. Okay. Oh, I should also note, Jonathan, three standard deviations is 99% of the time, but 2008 actually was down more than the negative 31. It actually was that 1% of the time. So it does happen. You know, these are just statistics.
And if I recall, I think they said it was a 5 standard deviation.
That very well could be.
So
if we look at the far left, we have the 0% stocks, 100% bond portfolio. That averages about 5.7% return, so quite a bit less than the 11.3 we see with all stocks, but the volatility is also less. So there's a tighter dispersion of returns with that more conservative portfolio. So here's the key, and really maybe one of the most important decisions that any investor can make. Where do you fall in your risk profile between the all bond and the all stock? Are you willing to accept the volatility that comes with an all stock portfolio? It's great when things are up, but it doesn't feel so good when they're down. And nobody can time the markets to miss those down periods, which we'll talk about here in a few minutes. Now, I should also point out, these are all averages based on 1950 to 2018. Take a look at that 11.3% return. I'm going to show you on this next slide what many in the industry believe will be the average returns going forward. So that all stock portfolio, the 100% stock portfolio, averaged 11.3 so far, going back to 1950. Most in the industry believe it's going to be 7.1 going forward. A lot of very famous, very respected individuals and entities in the industry are reducing their risk premiums over the next 10 years. And that type of a portfolio is expected to bring in significantly less return than it has over the last 10 or 15 or 20, 25, 30 years. And that's true across all of these different portfolio makeups. Now, one thing that remains consistent, though, is that even though the averages are expected to be lower, we still expect volatility. However, there is this perception that volatility most recently is higher than historical averages. That for whatever reason, the politics or whatever it might be, that volatility has all of a sudden in the last year or two spiked. And I really want to address that because it's not true. If we look here, this is a measure of volatility. It's called the VIX. The two lines going across are basically the average. Well, one's the average, one's the median. And what are we seeing?
We're saying that it's increased recently, but just to the long-term averages.
Exactly.
Now, we were well below average a few years ago. And so maybe it feels like it's gotten very volatile, but relative to history, this is kind of normal.
This is normal, exactly. And if we want to look at it another way, let's look at volatility in terms of 1% daily moves in the market. So this slide shows us, going back, the number of 1% moves up or down in the S&P 500 index. And you can see that year to date, we are well below the historical average. Last year, we were basically right at the historical average. It's just we're coming off a year that was super, super low. And the year prior actually was lower than the historical average. So it's important not to get too caught up in the moment and not to believe just because you may feel like something is the way it is, doesn't really mean it is that way. Allow history to help guide your investment strategy. Not current politics, and believe it or not even current economic data. We've shown this Venn diagram several times, and we keep coming back to it because it's so important to make investment decisions using data within your market sphere and not allowing your politics to overly influence your decisions on the portfolio or even the economic data, because, well, frankly, economic data is terrible. I mean, that's like driving using your rear view mirror, because every economic point you can give me is backward looking, not forward looking. So we have to be careful of that.
And that's an important point, because economic data is backward looking. Markets tend to be forward looking.
Very good point. Yes. So again, investors really should focus on their long-term goals, objectives, and what we talked about a few minutes ago, their risk profile. How much volatility are they willing to accept? Now, getting to that point about even though you think things may feel a certain way, doesn't make them that way. I love these next couple of charts. Normally, if you would ask, I mean, honestly, until I saw this data, you probably could have asked me, and you said, hey, Shannon, when unemployment is at the highest, do you think the stock market does really well or really bad? And I think, well, geez, unemployment's really high, probably economy's not doing that well. Stock market's probably not doing that well. But this chart is showing just the opposite. When unemployment is really high, historically, the S&P has actually provided more return than when unemployment's really low. Actually, the S&P in those periods have provided less return. And of course, we're down here in this really low. I think unemployment's what?
3.5.
3.5.
Yeah.
So totally counterintuitive to what you might expect. We see this also with year-over-year changes in GDP. The best year-over-year changes in GDP, I would have thought, provide the best returns, but we're seeing just the opposite. Actually, the worst returns come in those high year-over-year GDP periods, while GDP year-over-year, when it's lower, actually provides the highest stock market returns. Of course, here we're kind of in the middle, not clear guidance one way or the other. And of course, consumer confidence works, completely counterintuitive as well. When we have high consumer confidence, we see markets averaging lower returns than when we see consumer confidence really low. All completely counterintuitive. And I love this one, Jonathan. You pulled this together, you and the rest of the team. And I mean, this is a great example. What if the following occurred? I mean, this just seems like so obvious. You got subpar GDP growth. You got double dip recession. You got unemployment peaking at 10%. That just seems unfathomable. You got short-term interest rates going all the way up to 16. I mean, right now they're at 2. You got inflation and oil spiking. What would you think happens in that kind of a period? I mean, that just seems obvious, doom and gloom.
My gut reaction would be, we're looking at 1973 in a bear market.
Yeah, that's what you would expect. But of course, this is the period of 1974 to 1984, and what happened with the stock market during that period? It was up. Annualized 14% in large cap US, 22 mid cap, and 27 small caps. So again, we want to stress past performance is no guarantee of future success. And if we, heaven forbid, entered one of those similar types of economic circumstances, we don't know that the stock market would perform the same. But this just is an example of, even though something may seem so obvious, that the markets may not actually react in the way that you would expect. And this gets us to a discussion on market timing and a buy and hold strategy relative to trying to time the best and worst days. We'll start with the buy and hold strategy. We have the various returns over the last 5 years, 10 years, and really since the Great Recession with Lehman Brothers going under. Now, I'm the first to admit that if you exclude the 10 best days, yeah, you're going to get a lot lower returns. I mean, we see those kind of statistics all the time. But it's kind of hard to miss, frankly, the 10 best days or the 10 worst days. So if you miss the 10 best days, you're not going to be doing as well. Same should be true if you miss the 10 worst days, right? You're going to be doing a lot better. We're going to show that it's likely if you miss the best 10, you're probably going to miss the best worst too, or the worst. I say best worst. You're going to miss the best. You're going to also miss the worst because they're clumped. Mm-hmm. So if you exclude both, you exclude the 10 best and the 10 worst, you end up basically back to the buy and hold.
With a lot of stress.
A lot less stress with the buy and hold.
Exactly.
Yes, that's a good point. A lot less stress with the buy and hold. And why is it so difficult to miss the 10 worst days? Well, as I mentioned, they are clumped with the 10 best days. And we see this on this chart. And I don't really want to focus on the left side because obviously if you miss the 30 best days, you're going to do a lot worse than if you just stayed in a buy and hold strategy. I mean, that's pretty obvious. My point is on the right side of this chart. We have the 6 worst days and the 6 best days. This is since 1966, running through, I think, 2016 or 17. Look at this. 2 of the 6 worst days came within days of one of the best days. If you look here, 2 more of the worst days came within one of the best days. Here's another one where one of the worst days came very, very closely to 2 of the best days. And then we have another one where one of the worst days came very, very closely to one of the best days. They're clumped. The point is these things are clumped together. It's very difficult to miss just the worst days. You're probably going to miss the best days too.
Well, and the other side of that is if you sell because you just experienced one of those worst days, then you don't experience that recovery.
Exactly.
Period.
No, that's a good point. And I was just talking to a client about that yesterday. Somebody was saying, oh, you know, they look back to 2008 and there were friends of theirs that were selling like in early 2008 or late 2007, and they missed the big recession. And my comment was, but when did they get back in? Mm-hmm. Because you can maybe get one component of that decision right, when to get out. And that's a maybe. But most people, by the time they're comfortable getting back in, their market's already recovered. And they're better off having just stayed in, because probably what's happening is they're actually buying back in at a higher level than they sold out at, because these recoveries tend to happen very, very quickly.
And we'll actually see that on our next chart.
Good, yeah, good transition.
So maintain your long-term perspective, because when we're looking at this, we're looking at bull markets versus bear markets. The bull markets are the blue color and the bear markets are the yellow color. And so one of the things you'll see is that the blue periods are much longer and much higher returns than the yellow. So the question is, if you're trying to miss the yellow portions and you're going to miss then a lot of the blue portions, yes, what's the point?
Exactly. And the other thing is, we are on our longest US recovery in history when it comes to the economy. But if you look here, the bull market, you know, it's a long one, yep, for sure, but we've had other long ones as well. I mean, we look back 14.8 years, 12.7, 12.8. So we've had other long recoveries in history in the markets. And I love this one. The average bull market lasts 6.6 years. That's the average, with a total return of 334%. The average bear market, 1.3 years, with a loss of 38%. Now, don't get me wrong, that 38% is painful, but focus on the blue, because the blue happens way more than the yellow or orange. And I guess one more point to that, and I think it's going to be a discussion that we have in a future webinar. I understand that there may be a difference between holding through these cycles with dollars that you already have invested versus coming in with, let's say, $1 million of cash. You sold a business, you got a pension payout, got an inheritance. I don't know what it would be. But there is concern, I think, amongst a lot of investors when they have $1 million of cash, that they don't want to put it to work at the most inopportune time. And frankly, Jonathan, you know this, we have clients that started with us in early 2008 and clients that started with us maybe 12 months later in early 2009. And their average returns today are significantly different, because clients that wanted to go in 2008 all in, they unfortunately suffered the Great Recession. Whereas clients that started in 2009 really were starting at the bottom, and they didn't have to suffer that first year of downturns. That makes a big difference in average returns. And that's why even back then, and certainly today, we would probably have some type of a block trading strategy where if you came in with $1 million of cash and you asked us, what should I do as far as timing? We would say maybe put some of it to work now, some of it to work next month or next quarter, and then a little bit more the following month or the following quarter, because I understand nobody wants to put a big chunk of money in at one time and then suffer a significant, say, average bear market of down 38%. But this buy and hold strategy that we talk about, that is a very prudent strategy for current invested portfolios.
Absolutely.
So with that, we'll go very quickly through some updates and important reminders. Our IQs. We've put one of our positions on a watch list open and another position on a watch list closed. The difference basically means, can we continue to invest existing clients in the position or not? An open is yes, a closed is no. We are going to be releasing several white papers, one on international investing, one on tax loss harvesting, and one on donor advised funds. I encourage everyone to take a look at those. Those are going to be really insightful white papers. We are coming up on year end. Keep good tax records. Make the 2019, tax season easy for you and for us and for your tax preparer. So keep good records. We obviously do the same for you in the portfolio as it relates to the tax consequences. Take your RMDs by year end. Most of our clients we've already spoken with about RMDs. Ensure you have proper insurance coverage. This is always a great time to do that. Watch for year-end capital gains. They do look like they're going to be slightly lower than last year, but not much. And it's still a little early, so we don't know for sure. Okay. Consider tax loss harvesting. I wouldn't do that until you read our white paper.
Correct.
That's coming out very soon, and I would read that white paper before you do tax loss harvesting. Annual gifting. Use low basis stock for charitable donations. Review your beneficiary designations. Again, look at your insurance coverage. Other noteworthy items, there will be some increases to 401k contributions, HSA contributions, Roth IRAs, etc. Some of them have not been formally announced though. There are a few that are collecting Social Security, I'm sure, in our audience today. There is going to be a COLA increase. Unfortunately, that probably is going to be also tied to increases in Medicare premiums, which we do know the Part B increase. The COLA increase for the high earner premium, that has not been announced yet though. If there are any additional questions, or as I mentioned, topics that you would like us to discuss in future webinars, please reach out to your SilverOak advisor. Otherwise, you can call me directly at 952-896-5701. And with that, I want to thank everybody for attending and wish everybody a great day.